In this video, I'll provide a review of the Unilever stock and what I personally look for when evaluating potential stock purchases. My personal goal is to create a dividend portfolio that provides me with passive income. I think a lot of people get a bit too obsessed with the numbers behind their stock purchases. I do look at the numbers, but for me, stock analysis for my goals comes down to 2 points. Does the company have a history of paying reliable and growing dividends? And can the company continue to make profits and therefore pay dividends for decades to come? So what do Unilever do? They're a British multinational consumer goods company headquartered in London. Unilever products can be categorised into 3 areas: food and drink, home care, and personal care. Unilever owns over 400 brands, and their products are available in around 190 countries. It's estimated that 2.5 billion people use a Unilever product daily. That's a third of the world's population. Unilever brands are present in 98% of households across the UK, and 12 of their brands have an annual turnover of €1 billion. Some of their brands include Ben & Jerry's ice cream, Lynx, Domestos, Dove, Hellmans, Marmite, Radox, Wool's ice cream, Tresemme, and many, many more. Let's now take a look through the numbers that I find useful in evaluating stocks. Unilever has a current dividend yield of 3.47%. Last year's dividend yield averaged at 3.16%. So, as a dividend investor, it's always pleasing to see an increase in yield, which just means that I'll be getting more income per amount invested. Looking at the average yield over the last 5 years, it looks to have stayed quite consistent, which to me indicates a stable dividend and a stable share price with no major volatility. So, looking at the company website, Unilever first started paying dividends in 1999 and have paid them ever since without ever suspending a payment. They're currently on a 5-year streak of increasing their dividends. Over the past 5 years, the average dividend per share growth rate was 6.9% per year, and during the past 10 years, the average dividend per share growth rate was 7.4% per year. So although the growth appears to be slowing, it's still a very healthy growth rate for me and my goals if this trend was to continue. The payout ratio is currently 72.8%. This just shows the proportion of earnings a company pays shareholders in dividends, and is expressed as a percentage of the company's total earnings. With payout ratios, obviously the lower the percentage the better, and I do tend to consider around 80% as being quite a high ratio. However, if we look at the 10-year history of Unilever's payout ratio, we can see this is usually lower. The COVID pandemic has skewed these figures somewhat, as the average prior to 2020 was 62%. Unilever is listed on the London Stock Exchange and has a market cap of £113.78 billion. This makes it the largest UK company by market cap. I do like these large blue chip companies in my dividend portfolio, as they tend to be mature, stable organisations, and the dividends just feel safer than smaller cap companies or newer startups. Unilever has a share price of £43.49, which puts it in the lower end of the 52-week price range. The share price held up really well against the FTSE 100 index over 2020, which I feel shows the stock's strength. The current price seems to be quite reasonable when you compare it to the 50-week average of £42.69 and the 200-day average of £45.20. So now let's look at the quarterly dividend history of the company over the last 10 years. The graph shows a clear upward trend, and what I do like is that they were able to raise the dividend twice during 2020, at a time where a lot of other companies were suspending and reducing their dividends. I think this shows Unilever to be a very durable business and also demonstrates their commitment towards dividends for their shareholders. I'd imagine that with people around the world under lockdown restrictions, they'd be purchasing and consuming more products at home than they might have done if they were travelling around or in the office. And if we take a look at the yearly dividend chart right back to 1999, we can again see an overall upward trend, which I obviously hope will continue into the future. As a dividend investor, this all looks really positive for me. Businesses that can grow their dividends at a decent rate and maintain a stable payout can generate substantial wealth for shareholders over the long term. So now let's have a look at the chart showing Unilever's revenue, cash flow and net income. It's all very well looking at dividend history, but we also need to look at the company's earning potential and trends, as the revenue and profits of the company will drive future dividends. We can see a very stable revenue history, which tends to hover around the €52 billion mark, and doesn't take any sort of hit in 2020. Again, the consistency is very appealing to me, as it shows stability and a very resilient business even in an economic downturn. However, it is important to remember that businesses can't keep growing and growing into infinity, and at some point there is a natural maturity level where growth does slow down. This isn't an issue for me, as all I want to see is that the company continues to pay and hopefully increase their dividends. And if the business can remain at its current levels, then there's no reason to doubt that the dividends would be in any danger. The net income line was pretty stable as well, and then hikes up in around 2018-2019. So it seemed the company were using revenue more efficiently and therefore taking more profits. And if we look at the 5-year average profit margin, we get confirmation of this. It is a minor worry that after hitting the highs of an 18.38% margin, that it's dropped down to 11.6%. But with revenues of €52 billion, this is still a hefty amount of profit. As a qualified accountant, I like to have a look on the balance sheet at the cash flow of a company, as there's a saying that cash is king. It's nice to see that the cash line doesn't dip into a negative, which shows that they consistently receive more cash than they spend. If we take a further look at the total cash position over the last few years, we can see an average cash balance of around €4.35 billion, and a definite increase over the last 2 or 3 years. This bodes well for the business and for them to continue paying my dividends. So now that we've run the numbers, what is my opinion on Unilever? I believe that Unilever has quite a deep and wide economic moat which should protect it from competitors. A large number of people tend to stick with certain brands for large periods of time. They may have used Radox bubble bath for years and will keep on using it for as long as they live. Or they might remember using Matey bubble bath as a child, so they use it to wash their children, who eventually may use it to wash their children. This brand loyalty means that Unilever doesn't have to compete aggressively on price with less well-known brands. Brand loyalty also gives Unilever a degree of predictability. As long as the world's population grows in number and wealth, it's hard to imagine a future in which Unilever is not selling more branded products to more people in more countries in 10, 20, 30 years from now. As a very large company becomes even larger, the growth of its already enormous capital base begins to slow. Over time, I would expect to see its earning growth slow down, which would ultimately lead to a slower dividend growth rate. But in my opinion, if you are looking for a consistent, stable dividend payer, then I believe Unilever would take a worthy place in your portfolio. As always, this isn't investment advice, and you should always do your own research and due diligence. I hope that you've enjoyed this stock review and taken some value from it. If you have, then please like the video and subscribe to the channel to make sure that you don't miss any future videos. Also, please let me know what stocks you'd like me to review in the comments section below. Thanks again for watching, and I'll see you in the next video.